Hi, everyone. Thank you for joining us today. My name is Marsha Butler. I'm the webinar director here at Advice Chaser. Before we introduce our guests and get started, I need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Just a couple of housekeeping notes. Attendees are muted, but we do encourage you to ask questions using the chat box. And that is a feature I have to turn on. So let me go ahead and turn that on right now. All right, you should be able to chat with us now. The presenter will answer these questions during or after the presentation today. We will have a question and answer portion of the webinar at the end of the presentation. And if you ask a question in the chat box, go ahead and leave your contact information as well. And if we can't get to your question during today's event, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our presenter today. Robert DiPaolo has been in the financial services industry for over 16 years. He received his BA in finance from Hofstra University, as well as a JD from Hofstra Law. He started his career as an advisor at an equities broker-dealer and was a managing director of a hedge fund, as well as a partner at another mutual insurance company prior to joining National Financial Network. Robert enjoys helping people identify goals and design strategic financial plans to move towards achieving those goals. Robert is a certified exit planner, and this prestigious designation is held by less than 350 people nationally. As a director of business planning, Robert has a strong understanding of helping business owners find their why to design the most efficient plan to achieve both business and personal goals. He believes the greatest reward is not only personal advancement, but assisting others to achieve their peak potential. And Robert, we're really excited to have you here today. It's an important topic, and I'm going to go ahead and turn over the time to you.
Perfect. Thanks so much, Marseille. And as many people know, many business owners cherish their business as much as they cherish their family. And when it comes time to transfer that business, it really comes into play of how do you do it, who do you do it to, and how do you make it work for all parties involved? Because as you know, your work family is basically like a second family. It's an extension of people who you're around for lots of time during the year, during the day, and many different things that get involved in it. So when we talk about the transfer of the business, it's no different than talking about how to transfer grandma's house or how to split up family assets. And it has to be done in a very strategic and smart way, not just for your own personal purposes, but also for your employees, for tax purposes, for a lot of different reasons that we'll get into today, some of them on the high level. And I guess for the first slide, can you flip it over? When we focus on succession or generational transfers, one of the big things we talk about is many businesses don't sell to an outside party. Everyone sees these fantasized stories about how businesses transfer and how they're sold for millions of dollars. Yes, that happens on very large scale businesses. Yes, it happens on smaller businesses as well. We do have business brokers. We do have situations where I have clients who have sold them. But many times, shockingly, many businesses just shut their doors and close. Many times, it's a transfer to a key employee or child or someone internally that's already been involved in the business, because how the owner or people who work in that business value it versus how an outside person values it. Some people will look at a sale and go, oh, you only value my business at X. I'd rather shut the doors than sell it. They view it as an insult or some other situation, or the way they kept their books and records, or the way there's a million different factors. But if your business isn't in a sellable, vital state, because many times the owner may be a key element to the business, or how the relationships the owners or key employees have aren't as tangible and as visible to show that that outside sale doesn't really happen. So when that outside sale doesn't happen, what's the next best thing? Well, it's passing the business down to a key employee, somebody who else is as passionate about you to take it over. Many times we see this in plumbing businesses. We see this in trade businesses, contractors. We see this a lot in family restaurants or closely held restaurants with some employees that got really close. And how do you make that transfer? How do we make that successor the most viable option, not just for you, for them, and for all your other employees who are employed at the business? Next slide. So how do you identify your successor? Is it a family member? Is it a key employee? How do you know who to pick? How do you know who wants it? How do you know what factors to look at? When you look at these people, how do you let them know? How do you start grooming them? How do you start testing along the way? It's not something that happens overnight, but it's something that happens over time. So how do you start looking at these successors, and how do you know who to pick? Start identifying certain factors that are important. What is their experience? What are they able to do? What is their aptitude? How can they grow? And what is their possible knowledge base to run the entire business? And do they have the desire for it? I might have the greatest busboy in the world. He might love the business more than anybody, but if he can't manage the kitchen, the buying, and everything else of a restaurant, no matter how much desire he has, if he doesn't have the aptitude or ability to handle it, he might not be my successor. You might have the greatest chef in the world who can cook better than anybody. And again, I'm using a restaurant analogy because it's an easy one. But if he doesn't know how to handle waiters, if he doesn't know how to handle leases, if he doesn't know how to handle or ability to handle that, there might be a gap in ability that you can or can't hire to, which, again, once you know the experience, once you know what their ability is and you know what the desire is, the next thing to look at is, what are the potential gaps? So, next slide, please. So when you look at things, look at what skills you as a current owner are currently doing. What are you really good at? What do you delegate to other people? How are those skills materialized and monetized in the business? What skills does your targeted successor have? Do those skills complement each other? Do those skills present a gap in where there's potential issues that would affect the business when you're gone? Is there a potential issue that one of your skill sets only works because the other person is there? How do you identify that skill set? How do you identify those skills? How do you identify those potential gaps? And how do you account for them? Do you want to build into the plan that you might have to hire somebody to perform a skill? Because you might have a business that you have somebody that's a rainmaker that could bring in clients and they're the face of the business. You're the face of the business, but your successor is phenomenal at managing the books, phenomenal at handling operations. That's great. You could have the most efficient business in the world, but if you lost your rainmaker and can't replace it, the business isn't really worth anything. You might have somebody who is a phenomenal rainmaker and may bring in clients left and right, and they love being the face of the business. But if you don't have an operational partner, which might be your role as the owner, taking care of it and managing things from the back end, again, the business will fall apart, and you have to make sure when you as the owner step away, the business is in the most viable situation to handle future clients, future business, future success when you've totally stepped away from it. Next slide. And this comes to the next part of it. Why is that so important? Because a lot of times when you fund the transfer, there are other factors that are going to come into play, and you want to make sure that you can monetize it. Taking a family transfer first, one of the biggest issues that comes up is it's no different than dividing up your estate. If you have a family business, many times the business itself is a large asset to the estate. And when you transfer the business, this is usually towards the earlier part of retirement. So the assets that you currently have may be very different from when you pass. And if you transfer the business to one child, how do you account for it in your estate planning for others? Oh, John got the business, Billy and Bob will get the rest of my estate. Well, how do we know what that estate is? How do we know what it's worth? What I tell people is you don't know what your other assets in your estate are going to be worth when you pass. Don't assume that they will have a value to equalize to the business. Use life insurance, use other products, use other assets to transfer now to equalize your estate. Because if you draw a line in the sand and maybe Bob grew the business to be 10x what it was when you gave it to him, maybe Bob ran the business to the ground. But if Bob got an asset today and you pass away 20 years from now, they're not going to remember the value of the asset when you transferred it. They're going to remember the value of the asset when you pass and you look at the rest of your estate. And it usually leads to a lot of interfamily fighting and quarrels, which can easily be avoided through some estate equalization and other planning when you do proper transfers to family, when you do a succession to a family member or a generational transfer. When it comes to a key employee or sometimes even a family member, another aspect that really comes up a lot is how do they fund it? Maybe you have a son, there we go. Maybe you have a son who doesn't have the assets in the bank to buy you out, to give you the money you need in retirement. Maybe you have a key employee, again, great worker, great person who can run the business, but again, their finances aren't in line. They can acquire bank financing to push this to where it needs to be. How do you address that? How do you plan for that? This is one of the biggest hurdles and one of the biggest reasons why many people who look at selling their business shy away from it. Oh, Johnny can never buy my business because he doesn't have the funds to do it. Or Billy's the greatest employee I ever had, but he can't get a bank loan. Why would I ever sell it to him? That's short-sighted thinking. And with proper planning, especially if we do it far enough in advance, there are ways to plan around that. There are ways to build up equity in the business through seller financing or other aspects to possibly allow Billy to get financing from a bank, possibly allow Billy to finance, or whoever the successor is, to finance the purchase of the business using the business assets, using different things. What are some ways we can do that? Seller financing. What is seller financing? You're using the revenue of your business to fund your own buyout. In this situation, the key employee or whoever is going to run the business, and instead of the bank being Bank of America or Chase or someone else, you're the bank. Benefits to the seller, you get a little bit extra money. There's going to be interest. There's going to be things on it because you're going to be running the loan yourself. And if you believe in your business and you believe in your team, even though your successor may not have the wherewithal to fund the buyout or have the bank financing come in, if they can run the business properly and you believe in them and you know you have set things up right for them, you're taking the gamble to say, I'll be the bank. I'll give you the loan rate at whatever you set. And we kind of build that out through the seller financing, which is a very viable option, which many sellers, when done right, benefit from it because it stretches out their payout. That's not one lump sum that they could burn through. And it kind of helps build up the equity and credit of the buyer. And it kind of still gives you a touch on the business to step in if you have to help, because you still have a financial interest in it. Many times, aside from just putting the seller financing in place, the key to remember is if you're going to seller finance, you also still have to protect your money. If something happened to that successor, how are you protecting your retirement income? How are you protecting the funds that you are financing to get paid out from the business? So many times when we do that, we make sure to put life insurance and disability insurance on the buyer. So God forbid anything happened to them that was outside of their control, you're protecting your investment in the business until paid off. Now, again, this doesn't protect if they run the business to the ground, which as the bank, you're going to watch and monitor and make sure that they do the right things because you're financing this deal. But if anything ever arose, such as them getting disabled, such as them dying, such as them having a fatal accident, you're protected and everything you can do is protected against. Another tool, which is very often used, is deferred compensation. Many times, an owner will lower the price of the business to help the employee get financing. Instead of having the business be worth $1 million, maybe there's a way to cut that in half and make it $600,000 or $500,000 so that they could acquire bank financing and you get that lump sum up front, which you really want. And maybe part of that becomes a deferred compensation. Part of that becomes a payout you take over time. Part of that becomes other compensation that you'll take throughout your retirement. And we shift some of that asset into that deferred compensation bucket. That deferred compensation bucket, especially when you're selling it to a key employee, maybe income that you took in from the business or income that you shift in the business prior to even your exit to kind of build up that bucket and get some of that money built up so that the purchaser can finance that buyout the way you want. And that's another really good tool that many owners I work with use. Another avenue, which I use a lot of times when I talk with clients about this, is an owner consulting agreement. Maybe they sell the business. Maybe you have some deferred compensation. But what about having a consulting agreement? What about the new owner needing you on for a few years to give advice? Your time is still worth money, and you don't have to do it for free just because you're financing the sale of your business. Maybe having a consulting agreement as the exiting owner can be beneficial to you. Now you have a new income stream from you. You're a 1099 contractor. You set up a separate LLC, which is going to pay you and allow you to do different things, because one of the biggest things that you did as an owner, which is going to be one of the next topics we talk about, is how did you handle your taxations and your perks as an owner? Many times when you have a closely held business, a lot of owners run a lot of expenses through the business that they're not used to running on their own. Their car is a company car, their health benefit, their cell phone, all these different things, which were fringe benefits of them owning the business, go away in retirement. And having an owner consulting agreement allows you to take other income in and potentially offset some of those expenses still, because as a consultant or as a 1099 person, you still have a Schedule C. You still have those line items that if you can legitimize as business expenses, you can write off. And that again can lower your taxation, increase the impact of how much money you're getting from the sale in different ways to enhance that that sale of the business to a key employee while maximizing your net return from it.
We did have a question about the family transfer side. You
Yes.
said you could use life insurance or other sort of tools to equalize the estate planning. So the question was, when you go to transfer that business to the family member, at that point, are you paying out the other family members as well? How does that happen at the same time, or is that delayed?
So usually how that works is, let's say you transfer the business to a child. That child will have, that business at that point in time will have a value. The value of that business, you would acquire an equal amount of life insurance for each other child so that each child gets the same bucket of money. One child will get it today in the business. The other children would get a lump sum upon your death. So those children would not get it today, but there's a line in the sand that John got this today, Bob got this when I pass away, and it's this way it's segregated from your estate, and you have a set bucket set up to ensure that they get the same amount of money today or in the future that the other child got, versus having to gamble to see if there's enough assets in the estate to equalize that.
All right, thank you. That helps clarify things. Let's go ahead and move on to this part about post-transfer. We talked a little bit about it already. Yeah.
So one of the big things that happen with owners are, many times when you're a business owner, one of the biggest perks if you're the sole owner of a business, or if it's just you and one partner that you're close with, when you need extra money, you can always lean on the business to take a bonus, take a distribution, take money from your business. And once you sell the business, that piggy bank or that cash machine or whatever you want to call it kind of stops. How do you adjust for post-succession lifestyle? What is your income going to be? Will you be on a fixed budget? Do you have a fixed set of assets? Do you have an income stream that's going to come in? How is that income stream going to be taxed, as we were just talking about? There's a lot of components that go into this. And as we think about succession, it's not just about maximizing the dollar you get for the business, because your business could be worth $1 million and you get $1 million. But if that is your entire pot for retirement, what is your plan for living beyond that? Because $1 million may not be enough to support you throughout your entire retirement. So how do you adjust for that? You may have other income streams. How does that account for it? Because with those income streams coming in, if you don't have the business write-offs, what deductions are you going to have? What other things post-sale are you going to have to deal with that you're not used to? Now, like I mentioned, a lot of business owners have a Schedule C, have write-offs, have different things. When all that goes away and you don't have an active income stream and it's all passive, you kind of lose that Schedule C. You kind of lose that ability to write off a lot of things. And the value of a dollar changes. A dollar which you thought you kept 90 cents of, all of a sudden you may keep 60 cents of, you may keep 50 cents of. You have to account for that and know what the true adjustment to your lifestyle capital will be post transfer. Because if you don't have the Schedule C, if you don't have the write-offs, if you don't have the depreciation from the business, how does that affect other aspects of your business? Because those paper losses have a big impact on many business owners' income stream. And as we adjust for that, we have to make sure that you're realizing or accounting for real dollars in retirement, not dollars with paper deductions or paper losses, which many business owners appreciate, which is one of the benefits of owning a business. Now, how do you plan for this? This doesn't happen overnight. It takes time, and time can usually take place 5 to 10 years in advance. If you're looking to exit your business, one of the first things you should do is on that last runway, make sure you have things planned out. Make sure you're starting to size up and look for a successor. Start looking to see what that viable exit plan is for you. Start looking towards evaluation of your business at that point in time, because your business 10 years out may be worth $1 million, but you may have to make adjustments because your retirement income stream needs to get to $2 million or $3 million. Does that mean you take more money and start putting in a savings account? Does that mean that you start putting away for other retirement means, or start doing something to start padding to cover the gap you might have? Does that mean that you start looking to see who a potential successor is? Does that mean you start looking at competitors that might want to merge with you or buy you out? Does that mean you start prepping your family member? Because there's a lot of things that happen that usually take place 5 to 10 years in advance, because you have to start laying out these key components to design the plan that's going to work for you for your transfer or sale. Because if the ends doesn't meet, it doesn't work for you, how you get there can be a problem. So you might have to build up your business for the next 3 years to get that exit. You might have to start going on an employment search to find the right people to start hiring and being trained to be in your business. If you have one of those skill gaps we were talking about before, because you have a marketer who's going to be your new owner and you were a rainmaker, it might take you 2, 3, 4 years to find a junior rainmaker to train and take over what your responsibilities were. You may have a gap in that income, like I was talking about, you have to get revenue up. You may have to build up other means to kind of prep your business for that ultimate transfer, because it's not just stroking a pen on a piece of paper and it happens overnight. There are a lot of contingencies. And along the way, as you prepare for those, what are you doing to protect yourself and hedge for that in that planning? So when we talk about the contingency planning in that plan, what happens if your successor backs out? What happens if your successor dies or becomes disabled? Many times, a family business will think that a child will want to take over the business because they're working there right now. But your child might be counting down the days till you retire because they are dying to leave that business just as much as you are. And unless you have the conversation, unless you talk about it with them, you might not have a successor. They might think they love the business, but working with you for 2-3 years, realizing, seeing the other side of it, seeing the parts of the business that you do that they don't, they might go, I'm out. They may get a better job offer. Industries might change. Technology might change. You might be a ghostwriting company and all of a sudden AI came out. Your child might see that there's writing on the wall that this business is dying. You might make rubber stamps by hand and it might be a great artisan craft, but all of a sudden now everything's done by computers and machines that are more fine and refined and different. They might see that the future in your business might not be what you think it is, and your successor might look for another avenue or a change. Or you might be the local supermarket that gets a competitor like Whole Foods down the block, and your successor gets scared and leaves. There's 1,000,001 different scenarios, and you should always have a contingency or backup plan to that, because if they back out, what is your plan B? What is your other option? And always have 2 to 3 paths to go down, and as it gets closer to that final chapter and that actual succession, narrow it down to that one and know that you have picked the lane you're going down. And even over time, there might be situations in place where, yes, you picked your successor, they're involved, they're totally going well, everything's going well. You had to finance the deal. You had to put up the money to have your buyout happen over a number of years. And all of a sudden, your successor has a bad ski accident. They decide to get drunk one night on a ski trip and go sledding after dark and crash into a tree and end up in a hospital. Maybe they have some brain damage. Maybe they die. Maybe something happens to them and they can't run your business now. How does that happen to you? What's going to happen? Are you going to step back in, take over the business 5-10 years after you've stepped out and run it? You want to enjoy retirement. You want to do different things. And as you talk about those different things, you want to have, again, contingency planning in place. This is where the life insurance, disability insurance protections on your buyer, once they start taking over, come into play. Because if your successor went on that night bender and all of a sudden crashed into a tree while he was sledding, he's disabled. He can't run your business. You're not going to step in and run it. So you're going to want to make sure there's disability insurance that's going to pay you out a lump sum to cover your loan. You're going to want to make sure that if he dies or something happens to him, that you're going to get that lump sum and not get stuck with getting your business back. Have the problem of reselling or transferring your business not be your problem once you exit is extremely vital. Having to have them figure out their planning is vital, because again, as much as you might love your business and do different things, if you left your business at 60, 65, and now you're 75, 80, you're in no position. You might not even know the technology or what's going on in that business. So you want to make sure you're protecting your income stream, especially when you're seller financing. And the other thing you want to do is maybe you're grooming your successor. Maybe you have a successor who has been working with you for a year or two. They're not ready to take over the business, but you have kids, a spouse, other people who are dependent on you. You want to make sure that you have planning in place for yourself, that what if something happens to you before your successor takes over? How is your family going to be protected? And again, life insurance, disability insurance, as long as you're actively involved in the business, you should have those contingencies and that protection in place to ensure that you're properly protecting and managing things to protect your family up until the point that you sign on the dotted line and no longer work in that business.
Here's a question. The life insurance and disability insurance that you're mentioning, is that something that that the new owner has to maintain themselves, or is that something that goes into the sale of the business, that the premiums are already paid up? Talk about that.
So there's a lot of different scenarios and a lot of different ways that can come into play.
Mm-hmm.
A lot of times, if you're seller financing, it's built into the terms of the financing, and it involves something called collaterally assigning it. So collaterally assigning means the new owner may own it. You have all rights to it until you're paid off. And in there, you also get notices if they miss a payment. So while it might cost a certain amount of money to have life insurance on yourself or disability insurance for the term of the seller financing, which might be 5 years, might be 10 years, might be 15 years, they're responsible, and you built into the seller financing agreement that they're responsible to maintain life and disability insurance to protect yourself. And that's at their expense. And that will be built into the pricing because in their mind, they know it might cost them $2,000 a year, $3,000 a year, $5,000 a year, whatever the number might be, depending on their age, to maintain insurance on themselves. And if they're uninsurable, you might want to find other assets, other things to kind of hedge your planning. Like you might say, if something happens or at a certain point in time, you reserve the right to force them to get bank financing or something might happen, you might set it up in such a way that it depends on the scenario, depends on the people involved, but there's many different avenues where that gets designed, and that really depends on the parties involved. If it's your child or if it's somebody else, it's very different than if it's a key employee. If it's your child, you want to make sure that they're protected and their family's protected as well. If it's a key employee or if it's somebody who you've recently hired and you've trained and groomed to take over as an employee because you know you couldn't sell it in the open market, your emotions and your feeling towards a person or your connection to the person may be very different. And depending on those scenarios, may change how you tackle that question. I think
All
that's
right.
pretty much the entire topic.
Well, let's go ahead and answer some questions here, and then we'll close out here. Someone asked, at what point do you let your potential successor know that you're thinking about them as taking over the business, like, and also, kind of let them in on the back end and understanding the cash flow and all that stuff that's going on behind the scenes?
So what I always tell people is it's in stages. The first stage is you have to identify a time frame when you want to exit. Once you understand the time frame that you want to exit, the next thing is you have to understand the value of your business today. Having a formal or informal valuation run to know what the value of business is, what you potentially think you're going to get from it. If you were to sell to a third party, if you were to transfer to an employee, if you were to sell it to whomever it might be, assess that number, assess the possible taxation or costs involved in that transfer, and take that net number into account with your retirement planning. Does that number work? Does that number not work? Do you need to build up the value of the business to reach your retirement goals? Does that number fit in a certain range for you? Once you understand those variables and what you have to do and you kind of know how that falls, then once it's in range and it's achievable or transferable to like kind of plan it out, then you can potentially approach a successor. Then you can potentially bring up the conversation of, are you interested? Are you willing to start seeing if this is a potential mutual fit for you to take over? And slowly lean them into the business. Don't open up everything day one. Let them see how their abilities are. Let them see what your job details. Let them see what type of activities you kind of are involved in without giving everything away. And the more trust, the more interest they have, the more that seems like a fit. Slowly start easing them into understanding what the business really entails, and then slowly start discussing with them what potentially you're looking for to transfer the business. And if that all starts to seem to align and you have a potential agreement or potential transfer lined up in theory, then slowly start opening up the books to them more and more to see things, because you don't want to show somebody too much, because if they don't have a non-compete, if there's something that they could potentially take from you and become a competitor, you could potentially have a big problem. Because I've seen businesses, they start letting somebody in, no formal agreement, no nothing. When it comes time to negotiate, they realize that there's no non-compete. They realize that there's nothing hindering them from leaving. And they start telling a few key employees that you're out in 4 years, that you're leaving. He knows all the ins and outs, and he's opening a shop across the street. Do you want to come with him who's 20 years younger, or stay here where the business might be out of business in 4 years? So you always want to do it in a very controlled and set up strategically function for yourself.
You talked about getting your business evaluated. Is there a simple way to do that? Like it's kind of the back of the envelope. Okay, what's my business really worth? Can you talk a
So,
little bit about that? I know it's an
so,
involved process.
so there's different tiers to a business valuation. The first tier is back of the envelope, industry standard multiple. Many industries say, hey, it's 4 times my gross, it's 2 times my net, it's whatever. That's a very rough number. That's probably the very rough first starting point. Going to the other extreme, you have what's called a certified valuation. This is done by somebody who's an accountant or somebody who has professional designations that can give you a valuation which stands up in court. This is somebody who rips through your books. This is somebody who looks through every ounce of your business and gives you a very certifiable number. Now, that number is still not ironclad because there are things that are debatable. There are things that people kind of will look to. And many times, if you go to the extreme and it gets confrontational in a situation, many times if a partnership dissolves, you'll end up having 3 certified valuations done, one done by one party, one done by the other party, and one done by an agreed upon neutral party. That's usually the average of the 3, and that's really going to an extreme on the other side. But more often than not, there are softwares out there and professionals who use them who are financial advisors, like my office uses one of these softwares. And through knowing your SIC code, knowing through some very basic financial data, we can give you a more detailed valuation than back of the napkin multiple, but less intrusive than a certified valuation, a good happy medium to get a number done for most transactions. And the cost of it is a fraction of what a certified valuation will cost, because depending on your business, a certified valuation could be anywhere from $5,000 to $35,000, if not more, depending on how complex and how large your business is, because of how much work and how much how many things they have to look at and review.
Mm-hmm. So you talked a little bit about businesses that look at that evaluation and they just maybe insulted by what that is worth and just close it down. Can you talk a little bit about alternatives to actually closing, or the reasons that you see people are not transferring?
So again, everyone thinks their child is the most beautiful child in the world. Your business is just another one of your children. And in your eyes, they're perfect. In your eyes, there may be many things that you love about your business, but to an outside person, they see things you don't see. And if the value to them isn't there, there's a problem. Now, again, aside from you, who's the next best person to see the beauty in your business? It's your business partners, it's your employees, it's other people who have a lifeline or a bloodline connected to that business because they have a different connection to it. It might be an employee who might not ever get it. You might have an employee who you treat very, very well, who may never be able to get another job and compensate the way you compensate them because you compensate them over their skill, their ability, or industry standard for the type of work they do. That might be a perfect person to take over your business if it's not transferable. A lot of times when an outside party looks at your business, they look at, if I ripped you out of your business tomorrow, what's left? And a lot of times there might be relationships, there might be things that aren't tangible and aren't transferable the same way. And that affects the value of the business a lot. If you have contracts, if you have agreements, if you have things that are flowing in and out, that's a transferable business. That's a business that has a set value that's easy to triangulate. But if you're the local dry cleaner, your value a lot is your relationships. What you think it's worth and what you think that value is on the books may be very different than what someone else sees it for. They might see it for how favorable your lease is, how much your equipment's worth, what's the foot traffic in your neighborhood. And that might be one number to them, but you've been there for 25 years and everyone uses you because you're just that guy. That might not be the case for the next owner. So That comes into equation a lot of times as well, into how that valuation occurs. But more often than not, it's usually because the owner of the business is so critical and so vital that when he steps away, it's hard to replace him. And that value can't be transferred, that you see people shutting the doors.
Interesting. Well, what kind of, if you're kind of in the middle of your business, you're not ready to transfer yet, this is like our last question here, but you're thinking about this may be 15, 20 years down the line. What first steps are you going to need to do to set yourself up the right way so that it's a transferable business?
So the first step is, I always tell people this, work towards having your business able to function without you. Can you disappear for 3 months, 6 months, 9 months, and have the revenue of your business maintain status quo? If you can build your business to that point, you have a transferable business. Even if you have a relationship business, even if you have a business that's very tied to personal interaction, if it's not tied to you directly and those people are tied to the business, if those people have long-term employment contracts, if the business is set up in such a way that the tangible value that people see is set there, even if you disappeared, that you could go to Bora Bora for a year and your business still produces exactly the same or pretty close to it, you have a transferable business. If your business is set up in such a way that if you didn't show up tomorrow, your revenue depletes 75% or more, you don't have a transferable business. And that's usually a huge red flag and something that you have to work towards fixing as the first step.
Well, that's a great one to end on. I want to thank you for being here. I want to thank our attendees, and I want to thank the organizations that have made it possible to educate you about this important topic today. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.